Welcome to the AIER Standard, a production of the American Institute for Economic Research. I'm your host, Ethan Yang, and today's guest, Professor Will Luther, is the director of AIER's Sound Money Project, as well as a professor at Florida Atlantic University. His work focuses mainly on monetary policy, and if you've been on our website, you can see that he writes very prolifically on this exact topic, including some of the most pressing topics today, like inflation and price increases. Will, it's great to have you on the show.
My pleasure. Thanks for having me.
So let's get right into what I'm assuming what most viewers are concerned about, and why are the prices so high?
Yeah, prices are really high right now. If we're thinking about why prices are elevated, there are two conventional answers. The first is the answer that you'll hear from the Biden administration, and that's that we're dealing with some adverse supply shocks. Certainly, we have dealt with some adverse supply shocks. We went through a pandemic. The government shut down businesses in some states for a couple months, in other states for several months. And those shutdowns, and of course the virus more broadly, reduced our ability to produce. If we produce less and we have the same amount of money, then prices are going to rise as a result. So that's one explanation. Sometimes you'll hear that has been modified somewhat more recently to focus on the Russian invasion of Ukraine. This pushes up the price of fuel, and if prolonged, will push up the price of agricultural products as well. So this explanation is morphing somewhat, but we can put that under one broad header. Adverse supply shocks are the primary cause of inflation. Now, the other view is that we've had a failure of monetary policy. That view says, okay, there's nothing that the monetary policy authority in the U.S., the Federal Reserve, can do to offset adverse supply shocks. But it can at least prevent nominal spending from surging. And it hasn't done that. Nominal spending has been surging over the last year, and as a consequence, prices are higher today. And so those are the two broad views, that on the one hand, it's primarily adverse supply shocks, and on the other hand, that it's a failure of the Fed.
Mm-hmm. So I'd like to get a little bit more into what exactly are we seeing when prices are rising, because everyone's saying there's inflation, but I don't really know if the average person that uses that term can really point to what's causing inflation. So can you isolate for us what exactly what prices are inflating, and how do you even define inflation when prices are fluctuating all the time?
Well, when we're talking about inflation, we're talking about the general price level or the average level of prices. Of course, in normal times, some prices will go up and other prices will go down. If there is a reduction in the availability of corn, then corn prices are going to rise, and they're going to rise relative to other prices. And so we're going to get these relative price changes all the time. When we're talking about inflation, we're not really talking about relative price changes. We're talking about the typical price, right? What's happening to prices in general. And another way of thinking about this is, since we're thinking about the average price, we're also thinking about the value of the dollar, right? How many goods and services a dollar buys. So if the average price is going up, that means the value of the dollar is going down. So again, when we're thinking about inflation, we're not thinking about specific prices so much. Instead, we're thinking about prices in general.
But there is different spikes in different prices across the economy. So gas, for example, is really high. I think we have a baby formula shortage, but there's also areas where the prices are not spiking. So can you isolate why exactly some prices are spiking more than others?
Well, to the extent that some prices are spiking more than others, it's because the supply in those areas are constrained, or the demand in those areas have expanded disproportionately. But again, those relative price changes aren't really what we're primarily interested in when we're thinking about inflation. That's just part of the normal course of markets working, and doesn't really have any long-term consequence on the value of the dollar.
And so even though we're seeing gas is really expensive these days, something that may not be experiencing a price spike right now because of inflation could just become more expensive as the value of the dollar depreciates.
Well, it's becoming more expensive in dollar terms, right? So it takes more dollars to purchase those goods and services in general. But whether they're becoming more expensive in real terms is less clear, right? Because it's the value of the dollar that's changing. What we see historically is that wages tend to lag in these inflationary periods. So we've seen over the last year that nominal wages have gone up, but they haven't gone up quite enough to offset the inflation that we've realized. Eventually, those wages will catch up. And so at that point, prices will be higher because we've had this period of inflation, and the value of the dollar is lower than it was in the past. But in terms of how much goods and services cost in real terms, in inflation-adjusted terms, in terms of how many hours a typical person has to work in order to purchase those goods and services, that will be more or less unchanged, right? It'll just be the dollar value of these products that are changing in the long run.
So it's possible that as long as wages start to increase at a higher rate, that the more adverse effects of inflation could maybe be mitigated if that's the case.
Well, so we need to distinguish between the short-term consequences and the long-term consequences, right? In the long run, that's right. To the extent that this increase in the rate of inflation is temporary, even if it means that the price level is permanently elevated, then the long-term costs of this are relatively low. Eventually, we all renegotiate our contracts, and we factor in the change in prices that has occurred, and then we get on with our lives. The long-term costs of inflation come when you have a permanently higher rate of inflation. And so if that's the case, then you have to recontract more frequently. You have to change your prices more frequently. And so that means you have to incur the costs of recontracting and changing your prices more frequently. And anytime you're incurring costs to deal with inflation, you're not using those resources that you're expending to produce other valuable goods and services. And so society is worse off as a result of that higher rate of inflation in the long run. In the short term, whether or not this inflation is costly or not from a societal perspective depends on what the source of that inflation is. Now, if we were to accept the administration's view that prices are elevated today because of adverse supply shocks, well, then that's just the best that we can do, right? Prices are higher, but prices have to be higher because goods and services are more scarce, and so the market economy needs to signal that information to participants so that they can make decisions about how to use resources for production and consumption that are appropriate given the relative scarcity of those items. Unfortunately, that supply story just isn't consistent with the data, and so the cause of the inflation that we're realizing is a surge in nominal spending. The supply constraint story just can't account for very much at this point. A year ago, sure, we would be talking more about some supply constraints, but in terms of the pandemic, much of those supply constraints have eased up. And in terms of Russia's invasion of Ukraine, we're just starting to see the effects of some of those supply constraints, and they're relatively limited. So they don't really tell us anything about the inflation that we've seen over the last 6 months, maybe the last month or so, but not the last 6 months. And so that supply constraint story just doesn't really work. So if we're thinking about the costs, given that we know that this inflation is driven by a surge in nominal spending, those costs result from a misallocation of resources. Basically, that surge in nominal spending, it fools people into overproducing, into producing more than they would like to produce if they understood fully what the dollar is going to be worth in the future. So you got some folks out there who choose to give up their weekend and work overtime so they can collect those dollars. But then when they go to spend those dollars, they're going to realize that they don't go quite as far as they thought they were going to go. And actually, in terms of the real goods and services that they're going to be able to purchase with those dollars, they would have much preferred to have the leisure time, to have not given up that weekend. Similarly, you're going to have some businesses that see customers showing up and offering more dollars, and they expand production to capture those dollars. But eventually, they're going to go to spend those revenues, their profits, and those business owners are going to find out that those dollars don't go quite as far as they thought they would, and they should have charged a higher price for their products. And so the costs of this surge in nominal spending, which manifests in higher prices, the cost is really the misallocation of resources that occurs when economic decision makers overproduce, again, because they're fooled into overproducing.
And that brings me to, I guess, a pretty big debate that you just referenced is that I think it's pretty easy for most people to understand how a supply chain shocks might affect the inflation, but Milton Friedman, I'm sure, and a lot of very reputable monetary economists, I'm sure you're also in the same boat, would say that inflation's mostly a monetary phenomenon, and it's mostly because of the amount of money in the money supply circulating. So can you talk us through how that sort of view plays into all this, and how that might be a better explanation than the supply chain view?
Yeah, so, Milton Friedman said that inflation is always and everywhere a monetary phenomenon. But actually, the quote continues on. And the quote continues on in noting that it's a monetary phenomenon in the sense that it results when the growth rate of money outpaces the growth rate of goods and services. So we have to think about both, right? The growth rate of money and the growth rate of goods and services. Sometimes you'll hear people say that inflation results when you have more money chasing after the same amount of goods. But that implies that we can also get inflation when you have the same amount of money chasing after fewer goods. That would also push prices up. The difference between those two scenarios, though, is that an increase in the growth rate of money can be permanent. That is, the central bank can decide to allow the money supply to grow more rapidly permanently. And so that would tend to cause a permanent increase in the rate of inflation. But when we're looking at supply constraints, adverse supply shocks, those shocks tend to be temporary. The pandemic is a good example. The pandemic reduced our ability to produce valuable goods and services. For a few months there, we were concerned about our safety, and so a little less inclined to work with others. We faced some regulations, prohibitions on our business activity, and while those fears and those prohibitions were in place, our ability to produce was reduced. But those fears didn't last forever, and the prohibitions didn't last forever either. And when those constraints relaxed, then we were able to produce more or less as many goods and services as we were prior to that adverse supply shock. So what happens to output and prices over the course of a pandemic if you don't have a surge in nominal spending? Well, as our ability to produce declines, output falls and prices rise. And once those constraints ease up, output recovers and prices decline back to where they otherwise would have been. And so in that case, this temporary supply disturbance causes a temporary change in prices, but it doesn't cause prices to become permanently elevated. And it certainly doesn't cause the rate of inflation to become permanently higher. In order to see those prices remain permanently elevated, we would need either a permanent change in the supply of money or a permanent reduction in our ability to produce goods and services. I don't think that anyone is seriously arguing that the pandemic has significantly reduced our ability to produce forever. So no reason to think that prices would be elevated. And in terms of having a higher rate of inflation, what's required is even more on the production front. Not only would we need to argue that supply constraints have reduced our ability to produce, but they continuously reduce our ability to produce each period into the future. And so then as we produced less and less and less, prices would go higher and higher and higher. We would have a higher rate of inflation. Again, that seems implausible. It seems certainly reasonable to think that we had a temporary reduction in our ability to produce, which would temporarily raise prices. You might reasonably argue that there is some lasting effect of this pandemic, some production that will just never return. And so this will have a permanent level effect on output, but it would be pretty small. And so correspondingly, it would result in prices being slightly higher, along a slightly higher growth path than they were previously, but not growing at a faster rate. That's just inconsistent with that, with a supply shock narrative under reasonable assumptions about the nature of that shock.
And so I think the motivations behind the supply shock thesis are pretty clear in a sense that it shifts blame away from the administration and onto the more general economy. So I guess that brings us to the question of everyone's asking, whose fault is it, right? You see stickers on the gas station with Joe Biden's, I did that, right? It's a running joke these days. Some people might point to the Trump administration printing so much money. So where do you think the blame needs to be shifted? I'm sure it could be shared by both administrations, but where do you really see the story start to develop about inflation today?
Yeah, I think that we need to recognize that in the United States, the institution that has a mandate from Congress to provide price stability is the Federal Reserve. And so regardless of what the Trump administration or the Biden administration is doing, it is ultimately the Fed's responsibility to ensure that we have that nominal stability. And we don't have that nominal stability, which means the Fed is to blame for not providing that nominal stability. Now, we can extend some grace to the Fed. What they're trying to do is a difficult task, and we should recognize those difficulties in apportioning that blame. And it will, doing so will also enable us to be a little more precise about when they are more deserving of blame, when their excuses don't hold up. So if you were to go back, to the beginning of the pandemic, and just look across the time series over the first 6 months of the pandemic, what you would see in that period is actually a huge decline in nominal spending, and correspondingly a fall in prices. This was also a shortcoming of the Fed, a failure of the Fed. It provided to stabilize nominal spending in that it let nominal spending collapse. But it was a relatively short-lived problem. They stepped in and accommodated the huge increase in the demand to hold money. And if you would have asked me in January of 2021, I would have said, well, it's, unfortunately, they let nominal spending contract a bit, but given the difficulties of conducting policy in real time, at least on the monetary front, I think they did a good job. They did a lot of other stuff on the credit allocation front that I wasn't a big fan of. But in terms of providing monetary stability up until, say, January 2021, I think you got to give them credit for dealing with that relatively well. It wasn't until March of 2021 that prices returned to their pre-pandemic 2% trajectory. So if you were to plot a growth path of prices from January 2020, you would see prices fell below that growth path during the early days of the pandemic and didn't return to that growth path until March 2021. And even at that point, as prices began to exceed that growth path, I think you have to be a little slow to criticize the Federal Reserve. And you have to be a little slow to criticize them there because, remember, we had a pretty significant reduction in our ability to produce. And when our ability to produce declines, prices should rise. And so we should have expected and we should have welcomed prices to rise above that pre-pandemic growth path because that was what was required given the supply disturbances. It's not really until, say, late summer, early fall of 2021 when it becomes clear that the extent to which prices are elevated is just too much to be accounted for by supply disturbances, especially since by that point, by say October, a lot of those supply disturbances had already begun working their way out. And so at precisely the time when we should expect those supply disturbances to be relaxing and therefore prices to start to fall, it was at that time that we saw prices accelerating. And so that's the point where I think we need to start casting blame. In October, a well-functioning central bank would have looked at the available data and said, we've got a problem here. This isn't transitory. This isn't driven by supply shocks. Certainly supply shocks played a role, but there's a bigger issue here and an issue that we should address, and that issue is the surge in nominal spending. Our central bank didn't do that. They held on to that transitory term for at least another month. Chairman Powell famously said on November 30th, 2021, that he was no longer going to use the word transitory. So they had nominally given up that argument, but only nominally. They continued to act as if the inflation was transitory, as if prices were going to decline on their own, as they would if it had been driven by an adverse supply shock. So when they met in December, they plotted a course which wouldn't see them raise their policy rate until March. And then in January and February, they saw that data that they had been projecting would be bad. They saw that those inflation figures were actually much worse than they projected. Did they revise their course of action during that period of time? No, they didn't. When they met in March, they issued new projections that said they now expected inflation would be even higher, but they didn't change their plan. So if you just take their words at face value, in December they plotted a course which said this is how quickly we should engage in contractionary monetary policy given how bad inflation is going to be. Then in March they said, inflation is going to be, has been and will be much worse than we expected, but that same plan is going to do the job. It just doesn't make sense, right? If the data change, you need to change your policy. You need to course correct. You were wrong. Acknowledge that and plot a new course. The Fed didn't do that, and they really didn't course correct until May. So a problem that should have been obvious to Fed officials by October of 2021 was acknowledged later than that and not addressed until May of 2022. That's just unacceptable. So we should give Fed officials grace for trying to conduct policy in a pandemic, an unprecedented economic event. We should recognize that you can't turn a big ship on a dime. You got to take in that information and deliberate and make decisions. But by October, it was time to begin that course correction, and the Fed really didn't do that until May.
And so I'd like to talk about that course correction. As many people might be aware, the interest rates have been hiking in recent times. That's been causing a lot of turmoil in the stock market. So I was wondering, when it comes to interest rates, how much is enough? And then I guess how should have been done earlier? And if so, how much should they have done earlier? And I guess at what point does the Fed need to be more concerned about a recession caused by too much of an interest rate hike? And how do you think they should balance the two competing values of the need to increase rates to bring down inflation, but also that may or may not cause stock market troubles that may lead to a recession?
Well, it's notoriously difficult to judge the stance of monetary policy from interest rates, and the reason is because monetary policy affects interest rates in different ways. So a nominal interest rate depends on a real interest rate, which is determined by supply and demand for loanable funds, and our expectation of inflation. So the Fed can affect that nominal interest rate either by affecting our expectations of inflation or affecting the supply of loanable funds by encouraging banks to lend more. So if we see interest rates rising, or we see the Fed raising its target, we don't know whether the rate that it should be hitting is higher because of higher inflation expectations, or if it's higher because of some increase in the demand for loanable funds, or if it's because they have sufficiently raised their reduced the supply of loanable funds. It's just a lot of moving parts there. So, for example, in short-term market analysis, we tend to think of high interest rates as signaling tight monetary policy. But if we look around the world, the places that have the highest interest rates are places with very loose monetary policy, and as a consequence, very high inflation and expected inflation. And so are higher rates a signal of loose monetary policy or tight monetary policy? Like you would like to be able to say something definitively about that. Over shorter periods of time, as the Fed contracts credit, that will tend to put upward pressure on real interest rates, and so nominal interest rates will tend to rise as well. But to the extent that it's successful, it will also put downward pressure on those inflation expectations, which push nominal interest rates lower. So it's really difficult to judge the stance of monetary policy by looking at interest rates. Instead, the kind of things we need to look at are expectations of inflation. And we can do that by taking a look at bond markets. So you can look at the difference between traditional treasuries and treasury inflation-protected securities. These are essentially the same assets. It's just that one of these bonds is indexed for inflation and the other isn't. And so the difference between these two assets is a decent predictor of what bond market participants expect the rate of inflation will be. So at the moment in the U.S., since August of 2020, the Federal Reserve has had a 2% average inflation target. And we could be pretty confident that the Fed is doing its job if market participants were expecting inflation would average 2% over, say, the next 5 or next 10 years. And we don't see that. Those inflation expectations have come down since the most recent FOMC meeting, but they're still above 2%. And that's especially damning considering that inflation has been higher than 2% over the last year and would need to be lower than 2% in the future if inflation is going to be 2% on average. So market participants are basically saying that the Fed is not committed to its 2% average inflation target, that it hasn't yet done enough to bring inflation down to 2%, even over the 10-year horizon, and of course, even if it does a bit more to get that long-run spread down to 2%, it still will not have done enough to deliver 2% inflation on average over that period because of the very big miss we've had over the last year. So that's the measure I would look at to see whether the Fed has done enough so far or how much further it needs to go. And that measure is suggesting that the Fed's actions have been too little too late.
So I guess in hindsight, when do you think the Fed should have made a policy course correction given what was known at the time?
Yeah, I think that when it met in December, I would have been very happy if it had tightened policy in December. I think it was warranted there. I would have also understood if Fed officials said, look, it looks like we're going to need to tighten, but we're not going to do that until February because we want to look at some more data to be sure. We don't want to overcorrect here. They could have even said, we're going to have an emergency meeting before that if they would like. But suppose they wait until February. I think that would have been understandable. And then when February came and they had seen that the November data, the December data, the January data was worse than they had expected it was going to be, then they either should have contracted more or revised their plan to say, look, we weren't planning to raise rates by more than, say, 25 basis points when we met in March, but it looks like we're going to need to do a little more than that because the data is suggesting we underestimated the magnitude of this problem. So that's the timing I would have liked to have seen. And again, we can debate about whether it should have contracted in December or in February, and whether it should have done a little or done a lot. But it would be very difficult, I think, to justify what the Fed actually did, which was waiting till May, right? It made a small move in March, even though all of the data was much worse than it had projected. And then it didn't really course correct until May. That seems indefensible to me.
And so you would place the vast majority of the blame for the current inflation on the Fed operating independent of whichever administration was in power.
Well, there's always a question, as to what extent the Fed is truly independent. There are political factors here as well. Chair Powell his term was expiring as chair. He needed to be renewed by the Biden administration. It's at least possible that he was concerned that if he had taken a stronger stance on inflation earlier, that he would not have been renominated and he would not have been reconfirmed. And so, if I were in that position and we're thinking about, how vocal I should be about inflation, of course I would have to weigh those political considerations. That is, if you come out very hard on inflation, and then you lose your job, then you're not in a position to bring down inflation. And if you lose your job on the Fed because you were too vocal on inflation, what do you think the person who replaces you is going to be like, right? Surely they're going to be much weaker on inflation than you were. So perhaps there was just a shrewd political calculation here that said, look, I don't want to upset this administration, and so I'll drag my feet on bringing down inflation, because trying to act more quickly will actually result in even less action for the American people. I think that's a plausible interpretation of what happened. Of course, I'm not having private conversations with Jay Powell, so I'm totally speculating here. But that strikes me as a reasonable view for someone to hold.
So you would say that today's conversation, where people are placing a lot of blame on the Biden administration for maybe not issuing enough oil drilling permits or what have you, right? That may help inflation on the margins when it comes to liberalizing certain regulations, but the overall picture is mostly a Federal Reserve issue.
Yeah, anything that we can do to improve our productive capacity, anything that we can do to allow labor markets and capital markets to work more effectively so that we can produce valuable goods and services, we should do those things. And we should do those things regardless of whether prices are elevated or not, right? Those are things that are worth doing because they're worth doing. The inflation question, in my mind, is a separate issue. It's primarily driven by a surge in nominal spending, and ultimately, it's the Federal Reserve's job to stabilize nominal spending, and it's failed to do so. So by all means, to the extent that we can improve the real economy, let's do that. But that's a separate issue. On the inflation front, we need to get the monetary policy right.
And so on the topic of sound monetary policy, which is a buzzword that AIER likes to toss around every other day, obviously this is maybe have a resonance of I told you so, but what we talk about the gold standard a lot at AIER, and that's obviously been one of the huge pushes for some sort of monetary standard that's backed by a hard object rather than the fiat standard. So I guess in your mind, how would being pegged to gold or maybe a different commodity have affected the way the Fed worked during the pandemic?
So when we think about what an ideal money would do, an ideal money would do two things. First, it would anchor long-run expectations about the purchasing power of the dollar. That's beneficial because we're entering labor contracts and lending contracts. We're taking on purchase orders. So we're making decisions over time. And in order to make those decisions confidently, we need to know what the dollar is going to be worth in those future periods when we're receiving payments or making payments. So having that long-run nominal anchor, some surety about what the dollar will be worth in the future is very valuable. It helps us produce goods and services at a lower cost than we otherwise would be able to. The second thing that we would like a money to do, an ideal money would do, is to adjust the supply in order to offset changes in the demand to hold that money. If you have a sudden increase in the demand to hold money, like we had in the early stages of the pandemic, that causes nominal spending to contract. It puts downward pressure on prices, and since people are a bit slow to update their expectations, it fools them into underproducing. Likewise, when you have a reduction in the demand to hold money, well, in that case, nominal spending picks up. It puts upward pressure on prices, and since people adjust their expectations of prices slowly, it fools people into overproducing. Underproducing is bad, overproducing is bad. We want to avoid that to the extent possible, and so the way to do that is to allow the money supply to adjust, preferably in a very predictable way, to accommodate those changes in money demand. Now, a gold standard effectively did this. When the demand for money increased, the purchasing power of gold would rise, and that would give an incentive to miners to bring more gold to the mint, expanding the money supply, accommodating that increase in demand. And the process worked the other direction as well. So when the demand for gold coins, say, fell, then the purchasing power of gold declined, and miners didn't bring as much gold to the mint as they typically would. And so you had this automatic adjustment mechanism, and that automatic adjustment mechanism ensured that over long periods of time, the purchasing power of the dollar was relatively stable. So you had those two components of an ideal money: the anchoring of the long run purchasing power of the dollar, which enabled expectations to be anchored, and the mitigating macroeconomic fluctuation by accommodating changes in the demand to hold money. Of course, we should recognize that this system was not perfect. In particular, those adjustment periods could be quite long. So although it set in motion the supply adjustment, it took some time to dig up that gold and to bring that gold to the mint and to accommodate that increase in the demand to hold money. And so that money supply mechanism worked in the right direction, but perhaps not as quickly as we would have liked it to. That said, the banking system knew that adjustment was coming. They knew how that base money was governed under a gold standard, and so they could act to accommodate changes in demand somewhat, because they could take faith in that underlying base money regime. Today, that is not so much the case, right? The Fed doesn't do a great job providing a long-run nominal anchor for the value of the dollar. The value of the dollar is very difficult to predict in the future. That's why we don't see the kind of long-term, the very long-term bonds that we saw being issued under the gold standard. We don't see people issuing those today because they're far too risky to issue today, because we don't know what the value of the dollar is going to be worth in 50 or 100 years, like we did on a gold standard. And the banking system, participants in the banking system, they also don't know how the Fed is going to respond when there is a change in the demand to hold money. Are they going to accommodate it? Under the gold standard, it's going to happen slowly, but it's going to happen. Under our current system, it's not so clear if it's going to happen or not. And it's not so clear how quickly it will happen if it does. And so as a consequence, you get more uncertainty during that downturn, which makes the banking system a little less capable of dealing with those demand disturbances.
Well, that pretty much, we're pushing up on the time for this interview. So I'd like to ask one last question, which is, given the lessons that we learned from the surging inflation today, and then given the sort of insight you gave on what sound monetary policy looks like, What do you think is the biggest lesson that we should learn from today's experience?
Well, I think that the typical American should be aware that we get monetary problems when nominal spending surges or contracts sharply. And so the typical American needs to put pressure on their elected officials, who will then put pressure on the monetary policymakers to prevent that from happening. It would be great to if we could somehow overhaul our monetary system and impose some ideal monetary standard, but that seems pretty unlikely. Instead, what we can do is push for our current monetary system to deliver something much closer to sound money than it has, over the last year, and indeed over the much of the tenure of the Federal Reserve. So some marginal changes there, which begin with good ideas, I think would take us a long way towards sound money without requiring us to overcome some impossible political hurdles.
Well, with that, thank you so much for joining us today on the show and providing some really good insight on what I think is an issue that's troubling most Americans today.
Yeah, my pleasure.
Will Luther is the director of the Sound Money Project at the American Institute for Economic Research and a professor at Florida Atlantic University. If you liked what you heard today and you want to find more of AIER's content, make sure to follow us on all our various channels such as Facebook, YouTube, Twitter, as well as check out our website at AIER.org. If you really liked what you heard and you want to support more cutting-edge research like this, make sure to become a donor. All that information and more can be found at AIER.org. Thank you.